Very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself. Hello, Alejandro. Good to have you. Laritza, Gabriel, Horatio. Glad you guys could make it. Johan, welcome. Kingsley, good to have you. Mihail, Mohammed. Excellent. Got a good group here today already. And just as other folks are coming in, don't forget we're talking about different entries, exits, different instruments. All of this is from a educational perspective. It's not a signal trading service, and of course we can't offer a signal trading service because market conditions obviously change and move with market news. So that's just to make it clear before we get going. A very busy week. There is an awful lot of potential catalysts for change. So this is actually a very good week for trading. There's a lot of central bank action. We've got the Federal Reserve meeting, the Bank of Japan, we've got the ECB meeting this week. We've also got some crucial Australian inflation data and the Fed's preferred measure of inflation, the US core PC, and that's just the key data points I can remember off the top of my head. We're going to look through things throughout the calendar, but it's a very, very important week. If you could just let me know that my screen and my voice can all be heard. Hi, Johan. Super. Right, I'm assuming that screen and voice are all coming through a-okay. Okay, right, there's a lot going on this week, so we need to have our wits about us. First of all, let me just ground us in the major narrative, just so we kind of know where we're at and what's going on before we look into the detail. We don't want to miss the big picture. This is a very important week for earnings. We've got Microsoft announcing their earnings on Tuesday. Alphabet, that's Google, on Tuesday too. Meta is announcing their earnings on Wednesday. And we've got some big, large cap earnings from big oil names like Exxon and Chevron, as well as McDonald's on Thursday. So it is a big week for earnings. And the general consensus is that earnings are expected to be falling as the impact of higher interest rates, high inflation, slowing growth is starting to sort of work its way through the US economy. Now, the recent run we've been seeing in stocks, okay, if we just take a look here, and if we just go out to the weekly chart, what you can see is that stocks have been very, very resilient. And what a lot of analysts are concerned about is that, can these gains continue? Now, most analysts are expecting at some stage a correction lower in stocks. And if we just get rid of Bitcoin, let's just get the NASDAQ here. There we go. Right, now you can see here that the recent gains in the NASDAQ have been really pronounced. We have seen sort of a bearish rejection bar last week, okay? And this surge higher in tech stocks, a lot of it has been on the artificial intelligence hype. A lot of it has been just on, some very strong seasonals. The NASDAQ tends to gain strongly in July, and indeed it has done again this July. We're not quite at the end of July, but it's been, continuing the uptrend, at least for now. But a lot of analysts are very concerned whether this can continue. And the first thing to note is the Federal Reserve are meeting on Wednesday. And remember that interest rates drive economies. You cannot underestimate the impact of interest rates to drive an economy. If you wanted to cause a recession tomorrow, all you need to do is increase it, double interest rates, and you'll create a recession tomorrow, just like that. You can sink an economy. If you want to boost demand in an economy, just cut interest rates in half. And all of a sudden, you're going to boost demand, but then you've got to deal with inflation. So interest rates are absolutely crucial. And that's why the Federal Reserve's meeting on Wednesday is likely to decide the near-term direction in stocks. So expect heading into Wednesday indecision in the stock market. The key thing to notice in terms of expectations, we'll cover it in more detail, but The big picture is this. In the last Fed meeting, the Fed said via the dot plot, which is another word for the dot plot is the words for the dot plot is the summary of economic projections, SEP. The Fed indicated they expected 2 more rate hikes. Short-term interest rate markets say, no, we're only expecting 1 and a little bit. So the key decision that's going to be expected is the Fed going to hike on Wednesday? They're expected to hike once by short-term interest rate markets, nearly 100% expectations are going to hike by 25 basis points. That's all expected. But what the market is not sure about is the Fed going to hike by one time and say, that's it? We've kind of think we've reached our goal. We are pleased that inflation is falling lower. And we're going to say that the job's been done. Now, if you look at core inflation in the US, right? Look at that. You see, okay, 4.8. That came in lower than the market was expecting. Headline, look, it's down to 3%. It's getting towards that 2% target, right? So will the Fed on Wednesday say, yes, we're going to hike once, but we think we've done the job? Short-term interest rate markets are saying 1 more rate hike. So that's kind of, and a little bit. So if they say we've kind of done the job, then that would be supportive for risk. You'd expect the dollar to fall, stocks to gain, gold and silver to gain. Now, they're not likely to say that even if they think it, because they don't want to see stock markets getting ahead of themselves. They don't want to see the dollar sinking throughout, unnecessarily. They don't want to see too much market speculation. So they're likely to say, yeah, we're going to hike 1 more time and we're going to see how the incoming data goes. That's what I'm expecting from the Federal Reserve. So I'm expecting continued choppy price action through the Wednesday meeting, but that will put all the focus on the Friday, which is the Fed's preferred measure of inflation. And I'll deal with that today, okay? So that's kind of what I'm expecting. Now that's the big picture. And you say, well, Giles, why are you looking just at the Fed as being part of the big picture? Remember, the global financial economy is primarily driven by the monetary policy of the Federal Reserve. What the US do, the rest of the world essentially follows. If the US sneezes, the rest of the world catches a cold. In other words, that's a little saying to say that the US is incredibly influential in the global economy. So markets around the world are closely following US policy and closely following the way that the US is acting. So that's, very, very important. You cannot underestimate the impact of the Federal Reserve, which is why I've started with it, just to make sure that we've got the right focus. Now, with that being said, okay, we can start to look at what's coming in. So the first thing to notice is we've seen a whole swathe of weaker than expected purchase manager indexes. These PMIs, as they're known, are essentially surveys of leading manufacturing managers, asking them things like, are you expecting more orders or less orders? Do you think business is going to grow? Do you think business is going to shrink? Are you optimistic? Are you pessimistic? Generally basic questions, nevertheless revealing questions. And look at them. On aggregate, they've come in as a miss. So that is negative for the euro because it means potentially the ECB may be more cautious about hiking interest rates if growth is slowing so rapidly. That's why we've seen some euro downside. So from an intraday perspective, you would expect euro US dollar downside. So therefore, it would be acceptable for intraday traders to sell the euro US dollar from any retracements back up to that pivot point, stops above the R2 pivot, looking for a move either to the S1 or the S2 pivot zone. That would be acceptable. So intraday traders could potentially look at selling at 1.1120 at that pivot point, stops above the R2 pivot point, looking for a potential move down to that S1 or S2. if price has not moved lower by the end of the US session, so that's by 10 o'clock UK time, then scrap the trade and look for the next potential opportunity. But that would be a potential intraday opportunity, okay, based on that very, very weak PMI data that we've had. The other thing to be looking at a currency that has a reason for strength today and pairing it with any other currency that has a reason for strength. The US dollar is seeing a little bit of a resurgence at the moment, so Euro US dollar downside kind of does make sense from a intraday perspective. Tomorrow we have German IFO data. That will be a key risk for the euro. If we see a big miss in the German data, you could expect another leg lower in the euro, and you could pair the euro potentially against a strong currency. Now, what I would use and what I do use is I use pivot points to define and manage my risk. So in this instance, selling from 1.1130 makes sense, but I would just very simply have my stops above an R2 pivot point, which is a daily pivot point, and they just work like support and resistance levels. Germany is so important and influential for Europe because it is the powerhouse of the entire European economy. Germany is the biggest contributor to the Eurozone's GDP, and as a consequence, German data greatly moves the euro in a greater proportion than other European countries. Germany and France are the two biggest players on the Eurozone pitch. So if we saw a miss below 90.7 for the current conditions, below 81.5 for the IFO expectations, and below 86.5 for the business climate, I would expect another short leg lower in the Euro US dollar. We have some other US data out, and if we saw a big miss in those prints, it wouldn't be surprised to see a little bit of upside in gold and silver, a little bit of downside in the dollar. However, with the Federal Reserve meeting on Wednesday, it would only be interesting for me personally if we had a big miss in the data. So not necessarily a great tradable opportunity that I can see there, but the German IFO data is potentially. And obviously remember, if you did pair that with the dollar, look out for dollar volatility around these data points. The 26th of July, on Wednesday, we have this data coming out of Australia. Now, the Australian inflation data is very important right now. And if you go along to my blog, I tend to update the blog with the most important significant central bank decisions. And I'm just sharing this now if I can. I'm just seeing if I can. Ooh. Oh, there we go. Right, that worked. So in the last RBA meeting, you can have a look. I sent the link just on the GoToWebinar control panel, but I'll tell you what the key point is. The key point is the RBA said they'll be on hold last week. They were when they kept interest rates as they were, but they said we may still have to hike in the future. Why? Inflation. They see upside risks to inflation. So that means the expectations for what the Reserve Bank of Australia do next at their next rate meeting will be heavily influenced by the inflation printout early Wednesday. Now, if you look at the moment, this is helpful because there's a 50% chance that they're going to hike by 25 basis points and a 50% chance they're not going to hike at the next interest rate meeting. So what that means is if this inflation data comes in much lower than economists are projecting, then interest rate markets will say, aha, the Reserve Bank of Australia have less reason to hike interest rates. They're probably less likely to hike interest rates if there's a big miss. So you expect the Aussie dollar to fall. Okay, so if you look at the trimmed mean year on year, if that comes in below 5.9, right, And if you look at the headline, if that comes in below 5.6, I would expect the Aussie New Zealand dollar pair to fall sharply lower. All right. If it's a high reading, if it's very high, you'd expect the Aussie New Zealand dollar to move higher again. Okay. So I think there's two ways opportunities here. On a higher than expected print, anything for the trim mean above 6.4 and anything for the headline above 6.5, that would give upside likely reaction in the Australian dollar. Because it's a 50-50 split. If we go low or go high, I can see there's a potential opportunity in both opportunities for an intraday trade. So that's definitely worth keeping a very, very sharp eye on. Okay. Now, if you look here, you can see the Australian trim mean. See, it's quite elevated, the core still. So you can see why the RBA have said we're not quite confident this is coming down. And if you look at the headline, yeah, it's pulled off that 7.8 peak. But look, March's reading still 7%. So that's 3 times higher than the target for the Reserve Bank of Australia. So they're nervous, understandably so. We then have the Federal Reserve meeting on 7 o'clock Wednesday. Now, I will cover this in detail on the workshop on Wednesday. So make sure you come back on Wednesday and I will share the latest pricing and the latest potential that I can see just a few hours before the meeting takes place. That's Wednesday, 1:30 UK time. I'll go through that as part of the workshop in detail. On Thursday, we have the ECB decision. Now, I'll show you here what's the issue here. Now, Christine Lagarde said very clearly in the last interest rate meeting that they would be hiking in July. Okay, as you can see, short-term interest rate markets are saying, look, 98% chance the ECB is going to hike in July. Okay, that's what's expected. But what the picture is a lot less clear is what they're going to do in September's meeting. Everyone's expecting an interest rate hike, but the focus will be on the forward guidance. So what I'm looking for on Thursday is if we see a more hawkish forward guidance. So if they hike by 25 basis points, look, we can see that's just expected by short-term interest rate markets and by economists, it won't be a surprise. But if the ECB say, aha, we may be hiking interest rates in September as well, I'd expect euro pound upside. Horatio asked an interesting question. And what Horatio says, just going back to this RBA print, what do I think, how will the market react to the scenario that the RBA, how will the RBA react if the CPI is in line with expectations? That's a really good question. So in short, I don't know. It's a lot harder to call a reaction when it's within expectations. But what do I know? Well, I can see that the trimmed mean, the core, is expected to fall from 6.6 to 6. So that's a lower reading. I'm also expecting the headline to fall from 7% to 6.2%. So looking at that, and given the fact that we can see that, okay, the headline is expected to fall a bit further. We can see the core is expected to fall a bit further. That should be broadly reassuring, but is it going to change that short-term interest rate market pricing? I can't see it will necessarily, Horatio, because I can still see a case for that being very similar if we get an in line with expectations. However, if someone put a gun to my head and said, which way do I expect the Australian dollar to go into that meeting, I would say lower. And I'm glad you mentioned this as well, because I forgot to mention something, which is, look at this seasonal period of weakness the Aussie US dollar has coming up. Pronounced weakness, nearly 75% of the time between the 28th of July and the 23rd of August, the Aussie US dollar has fallen on average 1.75%, during this period. So there's a pronounced weakness against the Aussie US dollar from sort of, 28th of July. And then if we just take a look at the Aussie New Zealand dollar pair, see if there's any, you know, seasonality there. Mixed seasonality with the Aussie New Zealand dollar, but that Aussie US dollar downside was quite marked. So that's like my best take on her ratio, but basically when it's in line with expectations, it just becomes a lot more of a coin flip, particularly with the short-term interest rate markets pricing in 50-50 anyway. You know what I mean? So I wouldn't have the conviction to kind of know which way it went. So that's what I'm expecting for the ECB decision. But again, if they are more hawkish and they clearly signal a September rate hike, and you can see at the moment, look, the terminal rate is expected to be 3.84. So if they clearly signal a September interest rate meeting, then you'd expect a little bit of euro upside, and I'd expect euro upside against the pound. So, you know, I'd be looking at something like euro pound upside. That would make a lot of sense to me. We've been seeing, look, we've been seeing some sort of rejection from the 100-200 exponential moving average. But if you look at the German bond yield spread against the UK gilts, right, you can see that is pushing firmly up to the upside. And if we just see if I can just make this disappear. I was going to leave that for now, but look, if you look at the green line, do you see the way we've just sort of broken through that trend line? And if you look at this on the sorry, I've got some funny trend lines in here. Let me just get rid of them. That's really making it hard. But you see this here. So we've got a bond yield spread breaking higher. We've got price breaking higher. So I'm expecting dip buyers. So if I got a very hawkish ECB, then look, I would expect more euro pound upside. Okay, that's what I would be expecting. Obviously, you can measure risk very carefully under that 0.8480 region, and then as long as we stay above that trend line, I'd stay with it. But obviously, please note that stiff resistance we've moved into, you know, and price is struggling to get through it. So, you know, it wouldn't be, could price move back down here, base at this level? Yeah, it could. So, as always, manage your risk. But the place I'll manage my risk is underneath that swing point for a euro pound upside. But a short-term opportunity on a more hawkish ECB, you know, euro pound upside, yeah, it would make sense in my opinion. There's obviously always risks with this outlook, and sometimes even when you've got the analysis as accurately as possible, you can still get it wrong. So bear in mind that sometimes markets can react in ways you're not expecting. So always be very careful with your leverage and make sure you're managing risk. Now on Friday, the Bank of Japan interest rate decision is ahead. Now, a lot of markets analysts have got this wrong about when the Bank of Japan is going to change their kind of interest rate move. There's been an enormous amount of speculation about the Bank of Japan changing their yield curve control. And their yield curve control is basically, you can see here, they just kept the bond yield curve capped at 0.5 and minus 0.5. And look at bond yields around the world, 3.8 in the US, 2.3 in Germany, 3.6 in Canada, 4.6 in New Zealand. Look, it's 0.5 in Japan. That's because every time the yield moves higher, Japan acts by buying bonds. So if they change that yield curve control, or if they hike interest rates, look for the yen to gain massively. And I would definitely think something like pound yen upside. Pound yen downside would make sense. So watch out for that. The main event is the core PCE print, and that will be an absolute crucial event to be looking at on Friday. I will cover that on Wednesday's workshop as well, because it's too important to deal with that now. Okay, folks, thank you all very much for your time. Take care and see you on Wednesday. Thanks now. Goodbye.